everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, our Chief Investment Officer. It's great to see you, Mark.
Hi, Carrie. It's very good to see you as well.
Mark, the markets have been up since mid-June after a steep decline in the first half of the year, but many investors fear this is a bear market rally. And as we read the headlines, there's a lot of mixed messages causing confusion. So, jumping into the details, GDP's declined over the last 2 quarters, and China's hitting the news with growing slowdown concerns. Historically, this would have been an indication of a global recession, yet the Fed is increasing rates, the labor market remains very strong. And although this month's inflation readings were encouraging, consumer prices continue to remain elevated. So, how do we make sense of what seems to be competing signal? Is it okay to feel optimistic? Is the worst behind us? What can you share?
So I think really with all the things you just mentioned, GDP growth weakening in the U.S., also weakening in China, as not to mention Europe. We are seeing some negative news, but we're also seeing some positive news. I think the positive news comes with all around what inflation will be and going forward. So what's really important, I think, in driving the market volatility this year is what inflation rate might be and what the Fed has to do to control it. And so I think a positive, really the last couple of weeks, has been the decline in the regular price of gasoline. That is seemingly the most important driver of quite a lot of what the CPI or what the inflation expectations are by consumers. And it's fallen from over $5 a gallon to $4 a gallon. Now, while it's still high, as you mentioned, those prices are still high. They're coming off their peak. And if we see lower food, gas, other commodity prices coming down, then that should mean that the CPI should continue to cool. And if that happens, I think the bear market rally that we're seeing has some legs. It has some sustainability because bond and equity markets reacted well to this most recent CPI reading because the Fed may not have to be as aggressive as it suggested it might be at the beginning of the year. All these things are really important to drive, well, will the markets recover? Will they stabilize? And there's some reasons to believe that that's happening. So one of the things we wanted to highlight in this chart is what the market has done so far this year. So after a very strong 2021, where markets reached all-time highs, what we saw is a pretty steep decline of the S&P 500. If you look at the graph here, it's the gray line. It's showing a drop from its starting point at the beginning of the year down to almost over minus 20%. That is a definition of a bear market, supported really, we think, by an inflationary environment, improving inflationary environment. Equity markets have begun to stabilize. And what we're seeing is an improvement, increase in stocks prices over the last 6 weeks, which is a really good sign. It's come relatively quickly on the back of those good inflation numbers. So financials and energy stocks that are really representing the value side of the market, as indicated by the blue line here, they've been the best performing so far this year and held up best throughout the period. And it's important because Wescott portfolios have a tilt really toward that value side of the market and has held up okay this year. On the growth side, which is the orange line, we've seen a steeper decline, a 30% decline. And that's where the stocks were more expensive and they had further to fall, I would say, in an environment like this. But what we're seeing, as markets tend to do, as soon as the situation changes, like the CPI may not be as strong or as high, that recovery in the growth sector has been very, very good. So our view is that as prices moderate, inflation expectations can also come down, which would be a very good thing, bring some stability and some improving conditions to the overall stock market.
Mark, you've previously shared with us that following a steep market decline, we often see a strong recovery. What's the basis of this trend, and what else can we learn by looking back at some of the historical experience?
Yeah, it's a great point, and I think history tells us quite a lot. It's important to understand the drivers of volatility in the market and what happens during recessions, if we are in fact in one, what happens during bear markets, if in fact we just experience one. So instead of looking at this year and in the last couple of years, we go back in this chart to 1926, almost 100 years ago, just to see what happens 1 year, 3 year, and 5 years after a decline of either 10% or 20% or 30% decline. So the market, as we just went through, has declined by about 20% from its high as so far this year. And that was through June. So we're sort of looking at this middle bar chart here. And the evidence suggests that after a significant drop in the market, in this case defined as a 20% decline, the following or the subsequent 1, 3, and 5 year returns are very, very good. And we're already seeing perhaps the start of a 1 year recovery that's in positive territory. And that's how quickly markets move. So our philosophy is not to try to time the market, but to understand that these declines are part of history and the recoveries are also part of history. And we want to make sure that we're positioned well for what comes next. So in the meantime, though, the actions that we can take are some rebalancing, as we did at the beginning of this year, and some tax loss harvesting for our client portfolios on the taxable side, where in declining markets, you can sell, take a tax loss, reinvest the proceeds, and capture the recovery, but at the same time, try to effectively reduce the tax bill at the end of the year. So all that said, there's opportunities that we can take during periods of volatility like this, but it's really important to look at the history and know that historically these declines do happen, but after 1, 3, and 5 year periods, we often see pretty positive returns going forward.
Terrific. And as you've mentioned today, inflation remains a key theme for us, but it seems that both the market and consumer confidence is building. So why don't you close us out today with a summary of our portfolio strategy and outlook?
Yeah, thanks, Carrie. I think always good to reassess where we are and where we're going. I think the first point here is important, that we're balanced and we're diversified. And so the allocations that we have to the equity market, fixed income market, and select alternative investments are really designed to balance out and provide some stability in markets as volatile as we've seen this year. So while last year's returns were really great, off the charts, this year's have been much more difficult. We want to have the portfolio components work together to balance out that volatility in the market. And we've seen evidence of that so far this year. The other thing I would say is that we were concerned with valuations at the end of last year in the stock market, but the re-rating, basically the decline in prices, but the earnings of stocks have been pretty resilient. The result of that is basically market valuations are a little bit more attractive. And I think that's really important when we look forward in terms of allocating to the equity market. And while GDP growth was technically negative for the first and second quarters of this year, which again, a technical definition of recession, we do expect that inflation will continue to ease from its highs. We've seen starting evidence of that, which will allow the consumer confidence to improve and spending to rebound as we expect. And all that we think is good for sustainability of this current recovery.
Terrific. Great update as always, Mark. If you have any questions or would like to discuss any of the topics we've covered in our webinar updates, please feel free to reach out to Mark or your advisor. And thanks so much for your trust in Wescott.